Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm A.J. Monty. This is a one-year daily candle chart of the S&P 500 ETF, ticker symbol SPY. And as I do each and every week, I left my lines on the chart from last week's report so you can see how the market is reacting to last week's predictions. And again, as I zoom in, you'll see that last week I said we would most likely rally early on to test this resistance level right here and then eventually pull back. Now, early on this week, Monday and Tuesday, we actually went lower and then came right up to the pivot point that I drew again last week, which is now marking this as resistance. You could see that the stochastics down here is starting to turn up again. What does that mean for the S&P? Well, there's a couple things, actually. First of which, if I zoom in just a little bit more, you will see that we have an increase in green volume on this very slight candle. That's a spinning top, very close to a doji. So what I think we could see is, I'm just going to erase this line, I think we're going to continue to see a test of this resistance up here, but I do believe that we're eventually going to pull back and move back towards that moving average. So it's basically what I'm drawing this week is exactly what I drew last week. I'm just moving it over. I could just erase that line to clean up the chart. Now, why is it that we could still see a possible rally to test this resistance before pulling lower? Well, the answer to that is actually found in the volatility index. If you look at VIX, my forecast for last week was that the stochastic would start to go up, and it did that. It actually crossed, causing the VIX to move higher. The VIX came very close to the target, but stopped at that 20-period moving average. Now you can see that the VIX is moving lower on this stochastic, showing lower momentum. So I think the VIX could very well go back down to test this support, which in turn would cause the S&P to rally because they're inversely related, before pulling back. Now, I think there's a very strong probability that the VIX will rally up. Again, I'm just moving this over because if you look right here, there is a very slight gap on the VIX. And if you look back at history, 100% of the time, gaps fill. Every single time. You can see back here. Once that gap was formed, it eventually moved up to fill the gap. And that is going to be the forecast for the VIX next week. I think eventually that gap will fill, and it will most likely bounce off of the support level. So again, longer term, that's still bearish for the S&P. Now let's take a look at the diamonds. Again, early on, I said that we would most likely go down. We did. We didn't come all the way down to support. But notice, the stochastic did cross like I said it would. There's the forecast from last week. And lo and behold, what do we have here? Thursday and Friday, we have back-to-back dojis right at this role reversal of the trend line, which is now acting as resistance. I still think the diamonds are going to pull back, so I'm just going to move this right on over. And I think that it will pull back right to support. More or less what we have here is a hung market where it's drifting at these higher levels, but not storming through this resistance. If we see a break in that trend line, which is now resistance, we could see a rally all the way up to these highs. And it's still too early to tell whether or not the markets are going to rally past that resistance point. We'll have to wait and see. Dojis are usually a sign of indecision. We find those at pivot points. You can see back here is a doji. What happened? It pivoted lower. Back here, we were 2 days off the pivot point, but there's another little doji. Here's a doji 2 days before the pivot point lower. And I think back-to-back dojis, not something that you see often, but when you do, you have to pay attention to those, especially when you see them stalling at a resistance point. So that's the diamonds. If we look at a more broad-based index in the Russell 2000, You'll see same thing. I said that we would most likely go down. I said the stochastics would most likely go down. That happened. So we hit the target on the stochastics, but I'll erase that. We did not hit the target on the Russell 2000, but I'm going to leave this in place because this is more of a 2-week forecast. You can see that this end of the line is bringing us right around to February 8th or 9th. So it could, again, stretch into the first week of February. Again, still too early to tell whether or not we've hit resistance. I see that there is slight resistance right here. If it breaks through, then secondary resistance will be obviously at this higher level up here. I still think we're going to see lower prices, but in the event that we don't, any short traders should be putting their buy stops in this area or definitely above this secondary resistance point. See, the stochastics is turned up a little bit, but the D line, the percent D, is still moving lower. If we look at the Qs, that's ticker symbol QQQ. It represents the tech sector. We did pull back early in the week, but we didn't pull back all the way to my target price. So this is still in place. I'm going to leave this intact just the way it is. I said that the stochastic would most likely go lower. And it did. It moved pretty well. It came dramatically off the highs, but the price did not reflect in the same fashion that the stochastics did. So we're still leaving the end of this line as my price target. It will also be a Fibonacci pullback or retracement level pretty much right there. And I think that resistance up at the top, back from the highs in December, will most likely hold. Okay, so overall, I still think that the market stalled. We have a lot going on politically. There's still a stalemate in Congress and between the Congress and the White House and the Senate with regard to the government shutdown. I do not believe that optimism is going to come back in totally until we see some sort of an agreement for bringing the government back and ending this shutdown. But until we see dramatic news out of China or out of Washington, I think investors are still waiting to see what happens. I saw a lot of stocks today, as I record this on January 25th, a lot of gaps on the upside. Ford gapped up, silver gapped up in a dramatic way, and if you know anything about gaps, you'll know that 80% of the time gaps fill. So if stocks are gapping right across the board, then most likely we'll see filling of those gaps in the near future. If you'd like to learn more about what we do at The Market Guys, just go to themarketguys.com. Right there on the front page, you'll see a link at the top that says videos. If you click on that video tab, you'll see there's a library of very short videos that we call market shots. And if you like to go down to the very bottom, you'll see a video right here off to the right, trading the gap. That'll explain more about what I talked about with regard to gaps filling and the percentages of times that gaps do fill and then eventually reverse. So you have a good weekend, and we will talk to you next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.